Today, we are going to talk all about how I am going to build my child's RESP. As I shared a couple weeks ago, we did enjoy the birth of our first child. And now, after all the chaos has ensued, things are calming down a little bit and it's time to focus on the future. And one way to do that is to start investing in an RESP so that one day when they decide to go to college or university, they have some cash on the side that they can put towards their education. Today's video isn't going to be so much about explaining, but more how you can do it yourself. So if you don't feel comfortable investing in the market, if you're unsure of what to do, I suggest you contact a financial advisor. What I'm going to show you today is what I'm planning on doing over the next 18 to 19 years. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. When I first started looking into the RESP, I made sure I did my homework. I had conversations with financial advisors. I then turned to Google to learn a little bit more about the program to ensure that I'm putting my child's best foot forward, especially when you take a look at how much money is being invested in there and taking a look at what the repercussions are of potentially losing that money. So again, just make sure that you've done all your homework. Make sure you feel the most confident with whatever decision you make. And I'm going to go over some of that research that I did just to give you an inclination of where my mindset is at. So I'll jump over to the first article here. And one of the things that I was able to pull out right from the get-go is understanding your time horizon. It's a little bit different than a retirement account, especially if you're investing over the long run. There is a specified time period where the kid normally realistically goes to school in between that 18 to 22. I know that date's been pushed back. For myself, I did it a couple years back, but realistically, we know that there's a time parameter and the goal is to have as much money as possible. So what does that mean? That means that realistically, if you're setting up for a newborn, you could probably add a little bit more stocks. You can add a little bit more risk. And then if your timeline is a little bit shorter, if you're only starting this for a teenage kid, then realistically, you want to preserve but also grow as much as possible. That way, realistically, you're looking at bonds or other fixed incomes. So because of the timeline factor, we will have to differentiate timelines, meaning shifting investment strategies. So we do a little bit homework a little bit later in the video, but just bear with me in terms of the mindset that we should be having when we're setting this up. So next is the risk profile. If you invest in the stock markets, will you get the jitters every time stocks go on a bumpy ride? If so, you may want to concentrate in less risky fixed income assets, especially if you're setting up for a younger child. But remember, the lower the risk, the lower your expected return. If you're comfortable riding out the market volatility, you may want to focus on stocks, especially while your child is young. If you invest too conservatively early on, you could be missing out on potential growth. On the flip side of that, if you're too aggressive as the timeline shortens, you risk locking in the losses that have happened, especially if the stock market does take a little bit of a dump. So with that being said, we get an understanding that we want to make sure there's as much in the pool, especially when the kid is graduating high school and then moving on to post-secondary education. So we're going to take a look at another website that I was able to find, which shows a great breakdown from age 0 all the way to 18 and then through the 4 years or 3 years of school, and gives you a great inclination of how you should rebalance the portfolio. So the first thing that I'd like to point out is that the $2,500 minimum deposit gets you a $500 grant. So they're giving you 20%. And that is up to a max of $7,200. So what this chart basically tells you is that if you contribute $37,500, you'll get the max $7,200 from the Canadian government. So taking a look at this a little bit further, they have only assumed the only contributions are going to be that $2,500 to get the free money from the government. But what we can see and what is the most important is the portfolio allocation. So early on, it's good to add a little bit of risk in that portfolio because realistically you're going to get more growth. And then as the kid gets older, we start to see stock percentages come down and then also the bond increase go up. So you're balancing that portfolio, and this gives you a good indication of what that portfolio should do over the long run. Now we'll take a look at this website just to see that I believe they have it at about 4.7% annual return over the lifespan. So this is something that is definitely very attractive for me. I can build something like this on my own without having to pay a financial advisor 1 or 2% a year in order to manage it for me. Then they're going to have me in ETFs and paying MERs, etc., etc. So when we talk about portfolio construction, it's nice to know how much percentage is in stocks, how much is in bonds. But the most important thing now is what funds are we actually going to hold? And the way that we do that is through ETFs. And what ETFs are those, you may ask? Well, I was able to find another resource online to show some example funds that we can add and mix into this portfolio allocation. So on the screen, you'll be able to see 3 different options: Vanguard, iShares, and BMO, and it shows how much asset allocation is in them. So this first one is 100% stock. So it owns a multitude of different companies, but it's all focused on equity. Now, when you take a look and we go back to age 0, you're going to own 90% of your fund in this ETF. Now, on the flip side, when they talk about bonds on this website, we can go down here and we can see that they have bond specific ETFs. So you'll be able to own 90% in the all equity ETF, for example, and then you'll own the 10% in a VAB or an XBB. So that is definitely one way that you can do it. After a year's time, you can rebalance the portfolio to then start selling some of that equity and adding it into one of these bonds. Another way that you can do it is there's other ETFs here that are kind of, total market, where they have 80% stocks and 20% bonds, 60-40, 40-60, etc., etc. So if you wanted to just play within these 4 or 5 parameters and not go in so much intricate in terms of the split percentages that we were showing before, that is definitely a way that you can do it. And the way that I'm going to start is definitely with the 90% of my portfolio in one of these all equity ETFs. And then what I'm going to do with the other 10% is I'm actually going to look at a money market ETF, or I'm going to take a look at the high interest savings account, because what is happening with the bonds, and I'm not sure if you're familiar, but we'll take a look at the Yahoo Finance, is that there's an inverse relationship. And the inverse relationship is that when bond yields go higher, the price of the bond comes down. And we can see that from the chart in the sense that interest rates have increased. Since 2022, bond prices have fallen off and yields have also increased. So maybe a good time to buy. I'm not entirely sure. But when we talk about what the goal of the RESP is that if I can maintain my capital, if I can maintain that amount in there and clip 5%, we've covered what high interest savings ETFs have accumulated in the past. I have updated the sheet to show there's about 4, 5, 6 different options on the Toronto Stock Exchange, and I've sorted them based on total yield after you factor out the management expense ratio. So when you take a look at that, the first one that comes up is the Evolve product. And the Evolve product, after you paid your fees, is doing about 5.33%. When you take a look at one of that other bond products, well, there's a risk that it could further decline. And the bond yields aren't as high. So realistically, right now, I'm kind of thinking in the short run, I'm going to put 10% into one of these savings accounts, have my 90% in equity. But then realistically, as my kid gets older, I think I'm going to start transitioning to bonds, because what the ideal relationship is between stocks and bonds is that they end up being a little bit of a buffer, or when one goes up, the other one goes down. So it's a little bit of protection in the portfolio. Bonds have not acted that way over the past 3 years, especially with all the chaos that's happened in the market. People were selling out of bonds, selling out of stocks. So it's very hard to say where that's going to go. But we've talked about it in a video a long time ago. The 60-40 portfolio is dead, 60% equity, 40% bonds. So I'm a little bit hesitant as to where I'm going to go, but I think that with this strategy that we pulled up in terms of having a plan, putting something together to show me every year, okay, we dropped from 90% equity down to 85%, putting together something like this, I think is probably one of the easiest ways and most efficient ways to do it. especially if you look at some of the totals over the long run to show how much you're actually paying to a financial advisor. I think that this is one of the best benefits for me personally. I do like this stuff. I do invest the time. I do the homework. But yeah, realistically, would you work with something like this to do a self-directed RESP, or do you leave it up to the experts of the financial advisors or anybody in the finance industry? Let me know your thoughts down below. If you like this video, if you like this type of content, we do cover the best high interest savings accounts, ETFs. I'll link that video above. We also do a lot of ETFs on the Toronto Stock Exchange, so make sure to check out some of those videos here. Take care. Have a great week in the markets. Happy investing.